Chris Preston, and welcome to Street Check, the best, well, today, one-person podcast in the history of Cabot Wealth Network. Brad is still out on his European vacation. Hopefully that's going well. He is mercifully back next week. But so today you just have me. Producer Madison was kind enough to join us last week. I'm letting her off the hook this week. So I'm just going to riff here at the top and talk about what's going on in the market, what's happened in the last week, what could happen going forward. And then later I'm going to welcome on Carl Delfeld, who is chief analyst of our Cabot Explorer advisory, global stocks advisory, which is doing quite well as money has shifted from the US overseas, some places in particular. And Carl has been able to capitalize on that. And actually, something he sort of foretold even before tariffs in something he calls the Great Rebalancing from U.S. equities into European and other markets. So I'm excited to talk to him about that. We'll do that shortly. But first, I'm going to go through sort of traditional big three here. No defend the take because there's no one for me to defend the take too, with no Brad here. But we'll go through big three items. Number one, has the market made a breakthrough? Technically, kind of. The S&P, as we record this at least, up more than 1% this morning on encouraging jobs report news, which I'll get to. But back up over 6,000 for the first time since February, and just barely over 6,000. That may change by the time you even hear this, but we've sort of broken through resistance, which was in the high 5,900s. 5,963 was the closing high set in the third week of May. The market had been sort of sideways since then. Down for a bit, up for a bit, but hadn't really been able to puncture that mid-May top, and now it has. Jobs report seems to be the latest sort of catalyst to trigger that breakthrough. Sentiment still remains down, but the evidence is improving. All the hard data has continued to be good enough to sort of counterbalance all the what we call soft data weakness, which is consumer and investor sentiment and fears over what tariffs could do to the market. Now, I did write and say on this podcast month or so ago, I think it was my defend the take, or no, it was back in April, I think. I said buy in May and go away. And so far that's looking, like a pretty good call. And my thesis was that stocks had been, knocked back quite a bit in April after, Liberation Day and all the tariff fears, so fearing the worst case scenario. And now, my premise was that after all the tariffs were put on 90-day pause, and there was all this money on the sidelines, the money would come pouring back in, at least for a couple months. I thought May, June would be a good time, and so far that's what's happened. But as those tariff deadlines approach, again, there's been no deals other than with the UK thus far. It helps that China is now on 90-day pause too. But, there's been some other stuff this week. Trump upping his tariffs or tariff threats at least on steel and aluminum up to 50%, I think from 25% before. That's not helping. But the market seemed to shrug it off, at least for now. It seems the market knows what to do with tariffs way more now than it did a month ago or 2 months ago. And so what we're seeing is that the market's, it's not jubilance, but the market, it's sort of business as usual, I guess, in the market. As volatility's come way down, and it's not as tethered to the tariff news, the way it was, a month ago or even a few weeks ago. So that's a good thing. But as those deadlines approach, so those were enacted, I think, second week of April. So that means, you know, second week of July, mid-July is when those would expire. Um, I think we might start to see some fear-driven or angst-driven selling again. So maybe in the back half of June, early July, if there's no deals between now and then. Now, we're all procrastinators, and Trump is no different. All these other countries are probably no different. So my guess is it will get close to those deadlines, at least most of them, with most of them. Now, since then, also, as we talked about last week, that federal judge ruled that tariffs in general are not constitutional, that, a president can't do it without congressional approval. Of course, that's been appealed. And I'm sure, barring the appeal working, that Trump will try to get Congress on his side with this. I don't know if that'll work. There's a lot, there's a lot you get caught up, a lot of noise you can get caught up in with tariffs, and we could talk all day about tariffs. We talked ad nauseum about them, but there it doesn't really do you any good, especially because now the market is sort of not tuned out tariffs, but is figured out figured out how to sort of not be not live and die by the it's not living and dying by the daily headlines the way it was. Hence, we're back at the highest point since February, and sort of approaching the all-time highs from February 19th. 6144 was the closing high. We're now at 6,004 as of this recording. Is this a breakthrough? We'll see. My next item, big three, number two, is the jobs report. The aforementioned jobs report came in better than expected. So, like I said, the hard data continues to be good enough. It didn't blow estimates out of the water. It was 139,000 jobs, better than the 126,000 that were expected by economists. Unemployment rate held at 4.2%. This is just this morning. 177,000 jobs were added in April, or at least that was initially reported, added in April. That was reduced down to 147,000 jobs. And actually, revisions from March and April showed that the U.S. labor market, added 95,000 fewer jobs than initially thought. So there is some weakness there, but we're not seeing the sort of the bottom fall out the way some had feared when tariffs were first enacted, when there are all these, federal layoffs. That's not what's happening. It's not, the jobs market is not cratering the way people had feared. So good enough is enough to sort of move the needle, and that's part of why stocks are up this morning. Number three. So this is something my colleague Cliff Droke, who was on here last week, we had a nice discussion if you missed that. He runs our Cabot turnaround letter, but he's also a gold and metals expert. And he pointed out that while things are, look good in the market now, and he's bullish, for the next few months at least, there's a eerie parallel, a not flattering parallel with 2007. With gold and stocks rising in tandem. That's not something that usually happens. Gold, usually one or the other. Gold is a safe haven. People flock to gold and gold stocks when there's a lot of uncertainty and fear in the market, and most other stocks are falling. And that's certainly what we saw early part of this year, and definitely through April when gold prices spiked above $3,400 an ounce, all-time highs, sagged back a little, but now they're sort of coming back or close to those highs. And that's sort of in lockstep with the rest of the market. Here's a quote that Cliff cited from mid-2007. So an ominous time. We didn't know it at the time, but is right before the subprime mortgage crisis. Don Hayes wrote, "I think I like what I'm seeing in the overall market, but all those gold stocks," as a reference to gold miners, were flourishing and gold prices were flourishing at a time when the market was too. And that sort of, as Cliff says, served as a harbinger of the problems to come um, within an otherwise strong equity market. So it doesn't mean that we're headed for a similar, I hope not, similar market crash like we saw in 2008, 2009 because of the Great Recession, subprime mortgage crisis, etc. I do think it's unsustainable to have both gold and the rest of the market continue to rise for an extended period. One of them has to, sort of has to um, give, I guess. One of the two things has to give, and the preference, even if you're, a gold stock investor, the preference would be for gold. It could be that gold is the thing as fear abates. It could be that gold and gold stocks are the thing that recede. And that would be a good thing. That would mean that, confidence in the market, confidence in the economy, consumer confidence are all bouncing back, and there's less fear and less of a need or people feel less of a need um, to flock to gold. So we'll see. That's something to keep an eye on. Sort of the ratio or the correlation between gold and stocks. Usually it's a fairly inverse one, or gold in the market. It's usually a fairly inverse one. So the longer gold stocks continue to rise, the more it'll be a bit of a red flag, or at least a yellow one. Yellow makes sense. It's gold. Um, One other thing I wanted to mention about the market that my other colleague, Mike Santolo, frequent guest and our chief investment strategist at Cabot, has mentioned is there's still, even though the indexes are up and have broken through their May resistance, is that there's no real leadership emerging. There's not many growth leaders that have really popped yet. I think across the board buying is better than what we saw in 2023, 2024, where, the market indexes were up more than 20% each year, but it was a thin rally. It was all based on the Magnificent Seven. Not all, but a lot of it was based on the Magnificent Seven, Amazon, Apple, Google, a handful of others that were carrying the market because they have such a huge slice of the market that they really carried things along with some artificial intelligence stocks. Um, the rally sort of broadened out in the second half of 2024, which was good, but then, things sort of fell apart the first few months of this year. Now, as the market has recovered, it is a bit more widespread. It's just that there's nothing carrying it. Um, there's nothing like the Magnificent Seven, which again is not really a bad thing. Magnificent Seven are actually down for the year. AI stocks aren't popping the way they were, but the equal weight index is up 1.8% for the year. That's not much. That's basically the same as the S&P, but the disparity between S&P and equal weight index the last few years was noticeable. I mean, the equal weight index from the end of the bull market rally in 2021 all the way until basically last August, equal weight index was unmoved. And remember, that's at a time when you factor in the bear market pullback of 2022 in the market, but then that was immediately followed by 20% plus, 2 years of 20% plus gains in the S&P. So, I know that we're getting a little bit more participation now. It's just there needs to be some sort of clear leaders that emerge as sort of a catalyst, at least if you're a growth stock investor. So that's also something that if and when that happens, if the market continues to rise, we'll see that. But right now, it's just sort of inching its way higher, but there's not clear what the catalyst is other than a reprieve from tariffs and tariff fears. And again, that's we're on the clock on that one. We'll see how much longer that lasts. And, again, if we get to first, second week of July and there's no resolution there, I think you will see fear start to come back in the market and for stocks to pull back. I do expect stocks to be up 6 to 12 months from now, maybe even up significantly. But I think there'll be some turbulence in the coming months, and especially in the next 6 weeks or so. You can't really predict what's going to happen in this administration or with tariffs specifically, but tariffs are an issue that aren't going away, at least not yet. So something to keep an eye on. So one thing before we get to Carl, I mentioned Cliff Droke, who was on here last week. If you're interested, if you listen to the episode, or if you didn't, I encourage you to go back and listen to it or watch it on YouTube. You can subscribe to Cliff's Cabot Turnaround Letter service today. We're offering, if you go to cabotwealth.com/street, we are offering his Cabot Turnaround Letter service at half the price, half the normal price. It's $497 for the full year versus the usual $997 for the year. So half price for today's listeners. You can find that again at cabotwealth.com/street. $497 for a service that, Cliff has done a great job. He's taken it over a year ago. He's a veteran of a couple decades of the stock market, and he's great at spotting turnarounds. And he is, as he wrote yesterday, or actually this morning, that he hadn't been seeing turnaround stocks pop as much until really the last week or so. I mentioned that the rally becoming a bit more widespread. There's some turnaround stocks that are really starting to show out, and a few of them, more than a few of them, in his portfolio. So again, cabotwealth.com/street to sign up for that. Okay, we'll shift gears and we will welcome on Carl Delfeld in just a second. All right, I'm joined now by Carl Delfeld, Chief Analyst of Cabot Explorer, our global stocks investing advisory. Carl, thanks for joining me. You're joining at a very prescient time to talk about overseas stocks, although you of course have a balance between U.S. and overseas markets in your portfolio. You sort of take a global perspective. Where do you, at the top, I was talking about where I see the market. U.S. stocks have, S&P at least, just broke above, May resistance. Still not quite back to all-time highs from February, but it's trending well. What is sort of your high-level view of the market right now? Now that we've moved sort of maybe not totally beyond tariff fears, but tariffs aren't weighing down the market it was the way they were a month or two ago.
Yeah. Well, Chris, great to be with you today. Um, I think maybe we've last few years, the trend has been, of course, U.S. market has
Hmm.
led the world, especially from the big tech side, the Magnificent Seven. But in general, the U.S. market has performed really well over the last several years. And this kind of goes counter to the way I've been talking about markets for decades.
Right.
And my major theme has been the world is filling in, meaning the US still accounts for, 22, 25% of world GDP, but the rest of the world is filling in, meaning emerging markets are becoming more developed. And over time, you should see more balance in the world in terms
Right.
of their economics and also their stock markets. So now I think we're seeing a little bit of a reversal, what we describe as a great rebalancing. Um, and so, for example, as you know, I went to Europe last fall for a couple
Yep.
months, and then this year a couple months in Asia. And it was really interesting to it sort of confirmed my view that, for example, Europe, I mean, their economies are doing fine.
Right.
Um, and in Asia, very dynamic and stable. So you're starting to see that happening. I mean, some of our picks for Europe are doing very well. We have a bank in Spain up 73% this year,
Mhm.
which surprised even me.
Right.
And I got this idea when I visited Madrid Stock Exchange. I just talked to, casually to a few brokers, explained that and they suggested this bank to me, which I knew of, but I certainly didn't think it was going to be up 73%. this, in such a short time. And then in Asia, I mean, Chris, we've been talking about Southeast Asia, which is between, you know, India and China. It's this region of like 10 countries that are really booming, and uh, ticker SE, has really done well over the last couple of years.
Yeah.
So I think what I'm encouraging subscribers to do is don't do anything abruptly, but slowly rebalance your portfolio to the world.
Right. Yeah. And, to your point, I think you cited this in your issue, Cabot Explorer issue a week ago. You called the Great Rebalancing thing last year before, I think before those winds shifted, in earnest with tariffs
Yeah,
this year. But to your point, this year, the Polish stock market is up 48%, Austria 34%, Greece
mhm,
33%, Spain 32%,
yeah,
Chile 30%, Colombia 30%,
yeah,
Italy 28%. You're seeing it is a time when US stocks are flat. China's market has done well, but also,
yeah,
there's a lot of baggage with the China market, obviously.
right.
In your travels, because you traveled to,
Mm,
to Europe and
mm.
to Asia, was there one region or market that, stood out as impressing you, seeming like more abundant or more flourishing than you maybe had thought when you went there?
Well, I I think Japan was really interesting because I went to school there many, many years ago.
Yep.
Uh, and so it was a great chance to reunite with some friends from the old days. But I think Japan seemed much more confident, much more independent. And so the Japanese market hasn't done all that well, but I think it's seen as more of a safe haven in the way people used to talk about Switzerland, which is another great market for people who want to diversify overseas, very high quality market. But I think Japan stood out. And so the problem is there's limited ideas. They have a lot of auto stocks, and that's a tough market right now. But I think Japan was a country, and I think they're almost perfectly balanced between China and the United States. About 20% of their trade is with China, 20% of their trade is with the United States. So it's sort of in a unique position. But I think Japan stood out in terms of Asia. In terms of Europe, uh, Eastern Europe, of course, is probably the place to be. And you mentioned Poland, and there's a Poland ETF, and
Yeah.
some of the countries that you mentioned, they all have ETFs,
Right.
which is another way to do it. I used to have when I was with Forbes, I had a country portfolio, and I'd have like 8 or 10 of these countries in it, and I'd rotate between them.
Right.
And people really liked it because it's interesting and almost fun to go in a country and out of a country, with the click of the mouse. Is kind of fascinating.
Right.
But
Right.
Poland's a shocker. Even this surprised me. Poland's per capita GDP is now equal to Japan.
Wow.
Yeah,
That's yeah.
that's
That's wow.
that's pretty shocking.
Yeah. Yeah. You mentioned yeah, you wrote that monetary tailwinds there and manufacturing momentum, Poland's skilled labor infrastructure and location make it a nearshoring manufacturing center and a hedge on China risk. And it's become a key NATO member.
Right.
Yeah, and by the way, yeah, some just to reel off some of these ETFs. Poland is EPOL, EPOL, Austria EWO, Greece GREK. So you can find those international ETFs. Like you said, good way to just hop in and out of a country, which you've done in the Explorer
Yeah.
with a lot of success too.
Mhm.
Um, yeah, another thing you've been high on recently, dividend stocks, which sort of been a little bit ignored recently, but you thinking that the momentum might be shifting back towards dividend stocks and as sort of a safety play, right?
Yeah. Well, yeah, in my most recent issue, I talked about gold, and we have a couple gold stocks, and I just added a silver stock, which is really doing well.
Right. Yeah.
Um, and then we have a Bitcoin ETF, which is been there about a year and a half and has done well. And so I talked about, people are looking to reduce volatility to make their portfolio is a little bit more conservative with everything happening in the world. So you've got gold, of course, which has had a good run. Bitcoin's, the proponents of Bitcoin call it the modern gold, which is a little
Yeah.
bit of a overstatement. And then so I brought up the third idea is to shift a little bit towards dividend-rich stocks.
Yeah.
And so I always have an eye on dividends when I pick a stock, especially the dominating stocks. The three, I think I have three in that bucket right now in the portfolio. So dividends normally uh, are a surprising proportion of total returns for stocks. But recently, because of the high flyers, the big seven stocks and big tech, which usually
Yeah.
don't pay a dividend, those
Yeah.
numbers have gone down. But I'm thinking the shift is going back to dividend stocks. So I added a ETF this week, and I think it's something that people can understand easily and makes them feel more comfortable when you have that cash coming in every now and then.
Right. Right.
Yeah.
Um, and just shifting back to, the Great Rebalancing. You have a webinar next Thursday. It's free. Next Thursday at 2 p.m. Eastern. So that would be June 12th at 2 p.m.
Right.
Eastern. You're talking about the Great Rebalancing and just some stocks that you can use to play that sort of avoid the U.S.-China tumult that's going on now. Talk a little bit about
Right.
what you're going to be, without stepping on it too much. Talk about what you're going to touch on there.
Sure, sure. Well, it would be nice if we can avoid the tumult between
Right.
with China,
Yeah.
because that's another one of my themes. I've been on for some time, uh, and I think it's almost unavoidable. But what you want to do is sort of manage it. So the U.S.-China rivalry is significant. I think long lasting. I think these tariffs are just one aspect of it. But you have China, which basically has come from almost nowhere in 1980. And so in little over 4 decades, it's come to be almost a peer rival of the United States and in
Yeah.
some ways dominates Asia.
Yeah.
And then you have the United States sort of adjusting to it, resisting it, and so you have this competition, and there's fallout. So what I'm going to talk about is I'm going to have 4 or 5 stock ideas and talk about some strategies, how you can deal with it successfully without like going completely in and out of the market and making abrupt changes. So that's going to be the theme. Certain sectors, certain types of stocks. We're talking about dividend stocks as well. So we're gonna talk about how you can manage the U.S.-China rivalry and keep your portfolio on track.
And yeah, that's titled Three Stocks to Grow Your Portfolio in the Age of the U.S.-China Trade War. That is on the cabotwealth.com website. Just go to the webinars tab. Again, it's free next Thursday at 2 o'clock, and I'll be on the call with you there. Um,
Great.
I should mention that we touched on Greece. Brad is actually, I believe, in Athens as part of his European
Oh,
venture. He's been gone a couple of weeks. I think he was doing the Parthenon, and
wow.
I think he's doing London maybe too. So
Hmm.
I guess it's my turn to go to Europe next. But
Yeah. Well, when you think of Greece, you think of shipping,
yep,
and that's a very interesting area. The shipping company is very cyclical, but you can make a lot of money in shipping. But Greece is very interesting. I've
yeah,
never actually been to Greece, so looking forward to an update.
yeah. It's funny. I've been to Europe only twice, and Italy and Greece are the only two countries I've been to.
Yeah.
So yeah, I've done the Parthenon and everything. Yeah, it's incredible there. But
Hmm.
yeah, I'm excited to hear Brad's impressions. But Carl, thanks for taking the time to join us again. Please join that webinar, free webinar next Thursday, 2 o'clock Eastern. We'll be talking about ways to make money in the age of the U.S.-China trade war. And actually, you wrote the book on U.S.-China trade war, Power Rivals, I believe. Is that still on
Power
Amazon?
rivals. Yeah, it was about the whole relationship, not just trade.
Right. Yeah.
But yeah,
Yeah. It's
Power Rivals was
Power
like 3 years
Rivals.
ago. Yeah.
Yeah. Is that
So
on
I encourage
Amazon
people.
still?
Oh, it's still relevant.
Still, but is it still on Amazon? Still selling on
Oh,
Amazon?
yes.
Yeah. Okay.
Yes.
All right. So if
Yeah.
people want to check that out, go there.
Hmm.
Um, Carl, thanks again. And thank you everyone for joining us on Street Check. And we'll be back again next week.